All right, today we're going to cut right through the usual headlines. We're digging into Raymond Siccaro's latest analysis, and it connects three huge, seemingly separate stories that are really shaping the global economy right now. We start with a fiscal bombshell that just dropped right here in the US. Then we'll pivot to a geopolitical powder keg in the Middle East. And then, and this is the big one, we'll uncover a massive opportunity that most investors are completely blind to. So let's dive in. So the whole analysis kicks off with this old Soviet-era joke. And it really sets the tone perfectly. It's just a great little reminder to always question the main story you're being told, especially when it comes to the markets. It makes you ask, okay, what's really going on behind the curtain here? First up, we've got a major event that just hit the US economy. And no, it's not a market crash or a bank failure. It's a decision from the Supreme Court. But trust me, it has some massive, massive financial consequences. Okay, so here's what happened. On February 20th, the Supreme Court made a move that sent some serious shockwaves through Washington's finances. With a single 6-3 ruling, they essentially pulled the rug out from under a core piece of recent economic policy. And this wasn't just some symbolic slap on the wrist. It instantly blew a massive hole in the nation's budget by questioning tariffs that the government had already collected and, you guessed it, already spent. And when I say a massive hole, I mean it. We are talking about $240 billion. That's the amount of money, according to Fitch Ratings, that was collected through these tariffs and is now suddenly in legal limbo. That is not a small number, folks. That's the kind of figure that can completely reshape a national budget. And the fallout from this is immediate and it is severe. This isn't just some abstract legal problem. I mean, think about it. The government now has this huge, unexpected hole in its books because the revenue it was counting on, well, it just vanished. So now they're stuck with a terrible choice. Either make painful spending cuts or go even deeper into debt. And to make it all worse, companies are already lining up, lawsuits in hand, to get their money back. The analysis calls it a fiscal gut punch. And honestly, that's the perfect description. To really put that $240 billion number into perspective, this one single ruling effectively wiped out revenue that's equal to almost 1%, 0.8% of the entire US economy. In the world of macroeconomics, that is a huge shock to the system. It's the kind of thing that could really start to put some serious downward pressure on the dollar over time. So, this domestic fiscal crisis, it doesn't exist in a vacuum, right? The analysis argues that while the US is busy dealing with this internal shock, there's a major external threat that's brewing. And that brings us to Iran, a geopolitical flashpoint that could become a massive wildcard for the entire global energy market. The analysis here lays out two very different ways this could all play out. On one hand, you have what's called episodic disruption. Think short-term flare-ups, things that cause oil prices to pop maybe $5–10 a barrel, but ultimately don't do any lasting economic damage. The real worry, though, is the path on the right. Structural disruption. This is where things get really serious. We're talking sustained threats to major shipping lanes like the Strait of Hormuz, potentially taking 2 to 3 million barrels of oil per day off the market. Now that is a scenario that creates real, lasting economic pain on a global scale. Okay, so with a fiscal mess brewing at home and a geopolitical storm on the horizon, you might be thinking the whole outlook is pretty bleak. But this is where the analysis zooms way out, and it highlights what it sees as one of the biggest opportunities in years, a potential supercycle in emerging markets. And look, this isn't just a hunch. The case for this is built on some really solid fundamentals. For starters, if you look at credit ratings, the agencies are actually more optimistic about emerging markets right now. They're seeing more credit upgrades than downgrades, which is the exact opposite of what's happening in a lot of developed countries. And get this, that huge AI build-out that everybody is so excited about, a huge chunk of the raw materials and resources needed for that, well, they're coming directly from these emerging economies. It really shows how their growth is directly fueling the biggest tech trends in the world. And there's another huge factor here that could pour what the analysis calls rocket fuel on this entire trend, a weaker US dollar. It sets off this powerful chain reaction. See, when the dollar gets weaker, it suddenly becomes cheaper for these countries to pay back their debt. At the same time, their exports become more competitive on the global market, and the commodities they sell, which are priced in dollars, become more valuable. It's a feedback loop that starts to pull capital out of the US and pushes it into these higher growth regions, just accelerating the whole cycle. And this isn't just a fringe idea. This view is really starting to gain traction. This quote here from a major asset manager at a recent industry seminar just captures the whole sentiment perfectly.
The argument isn't just that it'll be a good year, it's that we could be at the very beginning of a sustained multi-year period of outperformance for emerging markets.
So if the opportunity is so clear, what's stopping everyone from jumping on board? Well, the analysis points to one final and really crucial factor: the investor's own perspective. This quote, which was apparently overheard from a US-based investor, just says it all, doesn't it? It's that classic case of home country bias where we confuse what's familiar with what's safe. It's a totally emotional reaction that just dismisses massive global trends based on personal comfort zones. And it could mean leaving some huge opportunities on the table. And that really brings us to the final, challenging question that this whole analysis leaves us with. In a world where we have clear fiscal problems at home and really complex risks abroad, maybe the single greatest risk isn't in those unfamiliar markets. Maybe, just maybe, the biggest risk of all is choosing not to see the bigger global picture.